Good morning, good afternoon, or good evening, wherever you are on the planet, and welcome to the Monday, the 17th of March, Bull versus Bear webinar. Steve Mile on the call here for trading. Welcome, everyone. We're going through our usual run through in here for a Monday, which is slightly different to our usual daily run through. And then we'll take a look at what I like to call the shape of the week. Let's take a look at what's going on, what we had, what's gone on last week, what are the main macroeconomic, geopolitical, fundamental, central bank, data-driven themes that are pushing financial markets right here, right now. And we'll take a look at both what we've had and what we've got coming up to see where the flavor is, what's really going on. And why do we do this when we're day trading at trade day? Well, primarily because if there's going to be potentially more volatile points later in the week, it might be slightly less volatile, maybe in the early part of the week, and maybe you adjust your day trade strategies around that. However, as I've repeatedly said on these Monday webinars, we are living again in the second term of a Trump era, and kind of just following daily expectations of what we are expected to come out is not necessarily going to help us, because we get a lot more volatility and erraticism from the Trump administrations, and that means then we could get shocks coming at any point. So it's difficult to gauge where the volatile points might be. However, we can do our best and try to do that anyway. So looking back to last week, we've got the two reports in here, the macro summary and the macro matters. Remember, you can access this below where you're watching in the members area, given that you are watching this in the members area, not on YouTube. If you're watching it in our members area below, remember you have all the access to the Trade Day Macro Matters report and the Trade Day Macro Summary. In the middle section where we put our fundamental reports every weekend, the left-hand column in here, we have all the daily technical analysis reports that we'll come to shortly. And then on the right-hand column, you have all the news reports from our partners at LiveSquawk. So using the macro matters in here as our base to go through what happened last week, what we've got coming up. US stock averages, big losses again. If you look at the major averages, the Dow Jones, the S&P, and the NASDAQ, down between 2.3 and 3.1% last week. And that was despite the Friday rebound. Friday's rebound was the best up move we've had. I've got it in here somewhere, of 2025. So despite a really solid rebound, we were still down by those percentages last week. So significant losses. There's three main factors contributing to this. Two factors effectively contributing into the third factor. So the main factor is really the uncertainty around tariffs. One, will it lead to global slowdowns? Obviously, trade wars tend to lead to reduced economic activity and uncertainty, which can see a slowdown. Also on that front as well, potentially leading to upticks in inflation, because we've got basically tariffs just increase prices. So those two factors in here, and then potentially then leading to kind of my final factor, the third factor, which is the impact then onto the outlook for the economy. And then we've certainly seen a lot of investment banks, research houses shifting their views and seeing increasing threat of a US recession. And the saying goes, when the US sneezes, the world catches a cold. I think it's that way around, right? Yeah, US sneezes, world catches a cold. So then that would potentially lead to in some parts of the global economy moving towards more recessionary pressures. So all of that obviously impacting. So you've got kind of one factor is tariffs that impacts onto potential inflation, and then a slowdown of the economy. So that comes into the second factor. And then kind of the third factor, as it were, is the unknowns on the risk in here. So we're covering all this in the first two the first two sections here: recession fears and tariff worries still weighing on risk assets. And then finally, we've got the shifting geopolitical risks around the efforts to get a ceasefire between Ukraine and Russia, with the US trying to broker that deal in here. And although Ukraine has said they would be willing to accept a ceasefire, Putin pushing back on that, although there's some news from today, overnight, regarding Trump contacting Putin potentially tomorrow, Tuesday. So we'll be watching out for that. And this was all on the back of actually on the data front. Data was better than expected last week. US inflation actually cooled. It was lower than expectations in here. But, research houses, investment banks are pointing out risks on the downside, on the upside for inflation, which is the downside for the economy, on the upside potentially coming from tariffs. Despite the cooling inflation, so they're sort of still warning on that. And also the other thing is a lot of consumer sentiment data has been rolling over. So having negative consumer confidence, consumer sentiment data that we've been having coming through in here over the last few weeks, and that's really an impact from the tariffs coming through, sell off in the stock market, concerns around inflation. So the consumer is less positive. Maybe job losses coming through from what's going on with what Elon Musk is doing in the DOGE. So all of that in here leading to a falling consumer confidence as well. So focus this week really is going to turn to the Fed. No interest rate expected, so rates almost certainly on hold. We'll come to the CME Fed tool a little bit later, but we'll see there that very little chance of a change. But what is important in here? Remember, every 6 months, every other meeting. So the meetings, every 3 months, every other meeting, we get in here the Fed dot plot chart, and we get that. So we get that 4 times a year. So it's every other meeting pretty much. And so the Fed dot plot chart, it's the economic projection. So they give their economic projections. As part of that, we have the dot plot chart where the individual members of the Fed say where they expect rates to be at different periods. The most important one really we'll be watching is the shortest term one, which is the end of year expectation for the end of 2025. And then that gives us a kind of an amalgam of where we expect rates to potentially be at the end of the year. Does that measure up to where the interest rate market is pointing? Does it measure up to what the equity markets is pricing in? So that's going to be the key focus going into this week. We do also get US retail sales out today, so that's going to be important considering we're seeing the consumer starting to roll over. Our retail sales going to start to roll over. And the other thing is, I'm not sure what day it is, but we'll keep an eye on this. There is an article here. I'll check on the article as we go through. But they have, NVIDIA has its technology conference this week, where they're going to be unveiling new advancements in here. And so it's going to be interesting to see what they come up with, watching out for that. Not only do we get the Fed on Wednesday, but we also get in here Bank of Japan on Wednesday, and also the PBOC and the Bank of England, People's Bank of China and the Bank of England, both on interest rate decisions on Thursday. As I said, the main data from the US really is going to be US retail sales today. Other than that, we get various intermediate size pieces of data coming out of Europe and Asia, but really the focus is going to be on US retail sales today and then the Fed on Wednesday. Okay, and that's all covered here as well in the macro matters in here. If we go to the data today, you'll see retail sales. We're getting that now just under the hour. Retail sales in 52 minutes. So we're going to be certainly keeping an eye on that today. And then anything else we might get coming through on either tariffs or on, so here we go, morning bid, US retail sales under scrutiny. That's going to be the key focus today. Market's actually slightly lower in here. If you just slip on Treasury sector comments, we'll check those out. Now actually, and obviously eyes on upcoming Fed meet. But Scott Bessent in here talking about the market, the fact that we're now in correction positions in here. So the Nasdaq was already down over 10%. That's what's officially called a correction from its high, down 10% from its high. And the S&P 500 last week went into correction territory, 10% off its high. So official correction territory. Scott Bessent saying he wants you to stop worrying about the stock market in here. So relax. US Treasury Scott Bessent he's not worried about the reason, but then market's not particularly liking that. Futures indicate stocks are in for another rough day, pointing lower. And then in here, where are we? Yeah, so Trump in here said he's going to speak to Putin tomorrow. Tomorrow being Tuesday. Okay, so we're going to see where that ends up leading to. So definitely going to be monitoring that. Bessent not worried about market calls corrections healthy, or he spoke about that. US stock futures slip as Bessent downplays the sell-off in here. Fed in wait. Fed is in wait and see mode. Investors want reassurance they will act if needed. So that's going to be critical in here. You can see if the Fed, if they see signs of a slowdown coming, are the Fed going to be ready to jump? What are they measuring? What are they watching out for? It's going to be interesting to see if we get any, and they kind of hint at here, Fed officials prepared to lay down marker. So what is the marker on impact of Trump policies? Fed projections like to reflect uncertainty. So it's all the uncertainty around the tariffs means the Fed doesn't know what to do. Now, if it's going to be inflationary, they shouldn't be cutting rates, but it's going to lead to recession. Maybe they will because inflation is starting to ebb lower in here. So maybe if we see signs of a recession, they're going to be a little bit more aggressive on cutting rates. It'd be interesting to see the market. We'll have a look in a second when we come to the CME Fed Watch tool at how much is being priced in. As we said about in the video in here, investor looking to the keynote speech. Let me just check the date on that if it's in here. I think it is. Oh, where is it? Gosh, you would have thought they would have put the date, right? I don't see it here. Maybe it's today. The way this could be today. Let me have a see in here. See if we can just Google that one right here while we're waiting, because if it is today, that could be important. March 18. March 18. There we go. Okay, tomorrow. It's not till tomorrow. Okay. Yeah, looks like it's March 18. Okay, tomorrow. So there we go. What else do I have for you? So just run around through on the major markets in here overseas. We have nearly 1% up on the Nikkei and 0.75% up on the Hang Seng. Europe also up in here. Just over 1/10 on the UK FTSE. German DAX and French CAC both up about 0.3 in here this morning. But futures in here, where are we? We're slightly lower this morning. Just popping this one out. So you can see down slightly lower in here this morning. Down about 1/10 on the S&P. Actually, pretty much unchanged in here going into today on the NASDAQ. If we go and look at the Fed Watch tool, so we're seeing it pretty much nailed on, no cut in here. So that's 0%, nearly like 1% chance of a cut. So no real chance of a cut going into today's meeting. 75% chance we stay unchanged by the May meeting. So the market now pricing in pretty much nailing on June for the rate cut in here. Only a 26% chance we haven't cut rates, but you see in here slightly creeping up in here for maybe a deeper rate cut in June. And then pretty much nailed on that we get a rate cut by July. And then by the end of the year, what's the market pricing in? Somewhere in here, right? So this in here is 2 rate cuts. Here's 3 rate cuts. So we're going to know a lot more by the end of today. This should sort of, really start to reflect whatever the Fed tell us after today. Not after today, after this week. After Wednesday's Fed meeting, we're not going to know a lot more there. Yields been pretty static in here. We did this big push down to lower yields. The market then rebounded and then kind of sideways. So in consolidation, you'd argue that all the threat is still in here towards lower yields, higher prices, lower yields. And we're kind of staying with that in here at the moment. Still seeing an upside bias in here. But overall, I'd say the risk is potentially slightly shifting towards consolidation or maybe even lower prices, higher yields. On stocks in here, despite Friday's rebound in here, the bias is still low. When you can't get away from the fact that we've had this huge sell-off, 14% down on the NASDAQ, 10% down on the S&P in here, despite Friday's best day of 2025 in here, until we start to take out some resistances. And remember, okay, we are in the March here. We're going to roll across to the June. June rolls off at the end of March rolls off to June at the end of this week. So you probably start to think about trading June in here. In the next day or two, we're going to be changing these over to June. But actually on the charts in here, I've switched these to June from today. And if we go on to the 30-minute chart in here on the ES, you can see the market is starting to break above. These are the trend. I'm just going to redraw the trend lines that we had on previously in here. Okay, let's get these trend lines on. So you got this one that comes across here. Make this array and apply and save as default. Going out there, but this more accelerated one that we have. If I just come back to this here, whoops. This more accelerated one down through here. You can see the market's been flirting. We're kind of above that, but we're above that. What's the issue with this? When you ever see this, kind of a sideways reversal, what you really want to see is when the market takes out a trend line like this, particularly when you've got multiple touches. So you see it drawn off here and here, goes up, fails, comes back up, goes up, fails. So you've got multiple touches in here. When it reverses, you want to see an explosion, and we didn't see that explosion. So the market is not really showing you that it's overly short. The market's not showing that the shorts are desperate to get out in here at the moment in here. But I think if we can take out the peak in here, get above that high in here. Where's my data box? In here, if we can get above this high from crosshairs are not showing either. If I can get above the top there, 57.26.75, maybe that signals a base. It looks like a little bit of a basing pattern building, potentially like almost like an inverse head and shoulders. I think really needs to minimally clear that peak there at 57.26.75 in here to start to signal a better base, and then really needs to get above this trend line. That trend line's all the way up towards like 58.20 kind of area. Similar story for the Nasdaq in here. If I go and zoom in on that, and we do the similar trend lines down from the top. This one actually comes all the way from. You see, it's got multiple touches. Touch, moves up, and then accelerates away, goes up, gets close, moves away, and then again sideways reversal. Again, I think it needs to. We've kind of been flirting with that little peak there in here. So again in here, needs to get and clear above that peak there. So really above. The high there, 19,992. I mean, basically, it needs to get above 20,000. Back above 20,000 will really start to ease the bearish pressure. And then ultimately, then needs to get back above here, really, towards like really more like 20,400. But 20,000 would be enough, maybe. If you get above 20,000 and hold, we could be seeing a little bit more of a shift to more bullish. Small question. Today was the rollover day, right? Or did I mess that up? No, I mean, you can trade both at the moment. Right, you can still trade on March. Okay, March is still live, but I would suggest trading June TD Thor. You're probably on the data. You want to just check where the liquidity is really. So we do have a lesson on that to go and check on the liquidity. Where you want to see where the daily volume is, and also where at the moment I think the volumes are fairly split. I'm just going to check off screen in here. Where the daily volumes are. You can go to the CME, or you can go and look at but if we go right in, you can see, if I go back to say ESH, if we go and look in here, I go all the way down to like maybe a 1 minute chart. You can see it's not gapping around, so it's still kind of liquid in here. And if I stick on the volume, so volume's still healthy in here. If you look at that in the ES versus the, I'll put this back onto like a 30-minute chart. Look at the volumes in here. See, they're quiet here, but then this was back on Friday's volumes, by the hour. So I go to the daily on the ES. So here, back on Friday's volume was 1.5 million, and on the ESM, on the daily, sticking on the volume. Oops, not that one. Sorry. And remember, some of this volume though is picked up by the roll. So the volume was a lot bigger in here on a lot lower, 210,000 in here on the ESM. Okay, so it's not quite there yet, but I mean, in the next few days, the trouble is here, the liquidity gets split. The liquidity is so deep, you can trade either. But I would certainly start to think about trading on the June contract, the M contract. In here today going into tomorrow. Certainly by Wednesday, Thursday, you want to be on the June contract. Okay, hope that answers the question. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back. Actually, Duncan will be back with you tomorrow with another bull versus bear webinar. Okay, bye.